Okay, so let's unpack this. Picture it. It's 2017.
Right.
You turn on the TV, you flip over to CNBC, and there is Ray Dalio. And we're talking about the Ray Dalio, founder of Bridgewater Associates, a legendary investor, basically the guy whose whisper alone usually moves markets.
Yeah, and he was definitely not holding back that day.
No, he was going in.
He was calling Bitcoin a total bubble. I think he said it's not a currency, you can't spend it. And his exact words were, quote, "It won't end well."
Which, for a lot of traditional finance people, that felt like the final nail in the coffin, because if Dalio says it's bad, it's bad. But then, and this is why we're doing this deep dive today, cut to 2021.
Right, the big reversal.
Exactly. The very same Ray Dalio is at a consensus conference, and he just drops a bombshell. He publicly admits he personally owns Bitcoin. He actually calls it one hell of an invention.
And he even went a step further than that. He said he'd rather own Bitcoin than a bond.
Which is just a massive flip-flop for a guy like that. But I think it perfectly illustrates the headache that we're trying to cure for you today. Because if one of the smartest financial minds on the planet can go from it's a bubble to it's the future in just 4 years, where does that leave the rest of us?
Well, usually it leaves people stuck in one of two very extreme camps.
Yeah.
You're either in the crypto bro camp.
Right, the laser eyes on Twitter.
Exactly, screaming, have fun staying poor at everyone. Or you're the traditional investor who thinks it's all just, what did Munger call it? Rat poison. And you absolutely refuse to touch it.
Both of which seem like really dangerous places to be if you're trying to build wealth.
Totally. Because if you're too skeptical, you might be missing out on literally the best performing asset class of the last decade. But if you're too manic about it, you're going to lose your shirt when the bubble inevitably pops. We really need a third option.
Which brings us to the source material for today's deep dive. We are unpacking The Intelligent Crypto Investor by John Hargrave, published in 2026. And the mission here is pretty unique. We're trying to find what he calls the middle way.
The middle way.
Yeah. We're taking the boring, time-tested value investing principles of people like Warren Buffett and Jack Bogle, and we're slamming them together with the totally chaotic world of digital assets.
Which is funny because intelligent and crypto in the same title, it sounds like a total oxymoron, doesn't it?
It really does. But as we went through all this research, I realized it's actually just about risk management. It's about being prepared. So let's start with the most fundamental question, because the book spends a lot of time busting myths right out of the gate. What are we actually buying here?
Yeah, to understand what we're buying, we first have to unlearn what we think we're buying. And the author starts with probably the most famous story in crypto history, the pizza story.
Ah, yes. May 22, 2010. Laszlo Hanyecz.
Right, so he pays 10,000 Bitcoin for 2 large Papa John's pizzas.
Which, depending on the market price today, makes those pizzas worth, what, hundreds of millions of dollars?
Something absurd like that.
I really, really hope the pepperoni was good.
Right. But see, it's a fun anecdote about missing out, but the book argues it actually proves a massive economic failure. Bitcoin completely failed as a currency.
Right, because nobody in their right mind wants to spend something today that might be worth 100 times more next year.
Exactly. Economists actually call this Gresham's law, the idea that bad money drives out good.
Meaning you spend the bad money, the inflationary dollars that are losing their value, and you hoard the good money that appreciates.
Spot on. So, myth number 1. Crypto is a currency you use to buy coffee.
False. It is way too volatile and too valuable to spend on a latte. Okay, so let's hit myth number 2, because this is the one I hear constantly from the gold bug crowd. They say, Bitcoin is digital gold. It's an inflation hedge. When the economy crashes, crypto is going to save you.
And this is where the data in the book is really sobering. It looks at the correlations during major market panic events. So take the COVID crash in March 2020. The world was ending, right? Everyone was panicking. But gold held relatively steady. It did its job as a safe haven.
And Bitcoin.
It tanked. It was down nearly 25% in a heartbeat. And then, if you fast forward to spring 2022, inflation is spiking globally. Everyone is worried about the cost of living. Gold ticks up slightly. Bitcoin plunges 50%.
Wow. So it doesn't behave like money, and it clearly doesn't behave like gold. The book argues it actually behaves like stocks on steroids.
Right. It's a risk-on asset. It's highly correlated with the tech sector, actually. When interest rates are low and people are feeling super optimistic about the future of technology, crypto flies. But when fear sets in, crypto falls. and it falls way harder than almost anything else.
Okay, so if it's not a currency and it's not a hedge against inflation, what is the actual investment thesis? Why should you buy it at all?
Well, the big idea here is that you are buying a call option on the future of the financial system.
Okay, let's break that down for the non-finance listeners. What do we actually mean by a call option in this specific context?
Think of it as a low-cost bet with incredibly asymmetric upside. You're basically betting that the global financial infrastructure, the actual plumbing of how money moves, is being completely rebuilt. And things like Bitcoin and Ethereum are the first draft of that new system.
Because it's global, it's digital, and it's totally auditable.
Precisely. So you aren't buying a coin to spend at the grocery store. You're investing in the network itself.
Okay. So you're betting that in, say, 10 or 20 years, value is going to move across the internet the exact same way information moves today.
Right. And if that happens, these networks are going to be incredibly valuable. But if it doesn't happen, they go to zero.
That is a very binary outcome. It's either the future of money or it's literally nothing, which means we have to address the elephant in the room here, the bubbles. The volatility is just nauseating for a normal person.
It really is. And the book uses a fantastic historical example to kind of make us feel better about being confused by all this. Sir Isaac Newton.
Wait, the gravity guy.
The gravity guy. Arguably one of the smartest humans to ever live. Back in the 1700s, there was this massive financial mania called the South Sea Bubble. And Newton actually bought in early, made a really nice profit, and sold. Smart, right?
Sounds incredibly disciplined.
It was. But then he had to sit there and watch the stock keep going up and up. And all his friends were getting rich while he sat on the sidelines. And he just couldn't stand it.
Oh, no, don't tell me.
Yep. He bought back in at the absolute top of the market. The bubble burst, and he lost a fortune.
Though even a certified genius couldn't time the market.
Exactly. He famously said afterwards, "I can calculate the motions of heavenly bodies, but not the madness of people." But here is the big twist regarding crypto bubbles specifically. Most bubbles think Beanie Babies or Dutch tulips. They pop, and they stay popped. You don't exactly see a Beanie Baby resurgence happening today.
Thankfully not. My attic is full enough from the 90s.
Right. But crypto bubbles are different. They reinflate. The book points out this recurring cycle. The price crashes, all the tourists leave, but the builders stay.
That's a really important distinction. The infrastructure keeps growing.
Exactly. In 2017, the bubble popped, but during that crypto winter, all the major exchanges and wallets were built. In 2020, it popped again, but decentralized finance DeFi was built. And now in 2024, we saw ETFs being built. Every single time it crashes, the underlying tech gets better, so the next high is higher than the last one.
Okay, so we accept that it's volatile. We accept that it's basically a high-risk tech bet. How do we actually invest in this without having a heart attack? Because this is where the middle way comes in. The book proposes a very specific portfolio structure to handle this exact problem.
Yeah, this is the core actionable advice. The author suggests what he calls a big believers portfolio. And it looks like this: 60% stocks, meaning broad index funds like VTI, 30% bonds for stability like BND, and a maximum of 10% crypto.
Only 10%? That does not sound very crypto, bro. I feel like the Twitter crowd would completely laugh at that allocation.
And that is exactly the point. It's all about asymmetric risk. Just think about the math for a second. If you put 10% of your portfolio into crypto and the skeptics are totally right, it is rat poison, the whole thing goes to zero, what actually happens to you?
Well, I lose 10%, which stings, definitely, but I'm not living under a bridge. I still have 90% of my wealth safe in traditional assets. I can still retire.
Exactly. It doesn't ruin your life. But what if the believers are right? What if it goes up 10x or 20x, which, by the way, crypto has done historically? That tiny 10% slice can double the return of your entire portfolio.
It's like putting a supercharger engine on a Honda Odyssey minivan.
That is a great analogy. You want the absolute safety of the minivan, the stocks and bonds, but you want that little bit of nitrous oxide in the tank just in case.
Does the book have data to back this up? Because 10% feels so small, but you're saying the impact is huge over time.
They do. They tracked this specific big believers portfolio over a 7-year period. And it outperformed a traditional non-crypto portfolio by 68%, just by adding that one small slice.
That is a massive difference when you think about compound returns over a lifetime. But there's a catch here, isn't there? Because the math works perfectly on paper, but the psychology is brutal. Holding that 10% when you watch it go down 50% in a week is incredibly hard.
It's almost impossible for most people. And this is where the book dives into behavioral economics. It references Daniel Kahneman and Amos Tversky. They found that loss aversion is literally hardwired into our human brains.
Meaning we hate losing more than we like winning.
Right. The psychological pain of losing $1,000 is twice as powerful as the pleasure of gaining $1,000.
So we are biologically programmed to panic sell at the absolute bottom.
We are. So the middle way solution to this is automation. You simply cannot trust your gut. You have to use what the book calls steady drip investing, which is just dollar cost averaging. You set up an automatic buy for the exact same amount every single month.
Taking the emotional decision completely out of your hands.
Right. When the price is super high, your $100 buys fewer coins. But when the price crashes, when everyone on the news is screaming that Bitcoin is dead, your $100 automatically buys way more coins. You end up aggressively buying the dip without ever having to summon the courage to actually click the buy button.
Now, here's the part of the book that really surprised me. Because usually, standard investing advice is to rebalance your portfolio. Like, if your stocks go on a tear and become 70% of your portfolio, you sell some off and buy bonds to get back to your target 60-40 split. But the book specifically says, do not rebalance your crypto portion. Why is that?
It feels very counterintuitive, I know, but it is crucial. Crypto follows what we call power laws. The gains in this space don't come in a nice, steady 8% per year. They come in these massive, violent spikes, often thousands of percent in a very short window.
So if you rebalance,
You're constantly cutting your flowers to water your weeds. If you sell a chunk of your Bitcoin every single time it goes up 20% just to buy more bonds, you're going to completely miss the 1,000% run that happens right after. The data actually shows that for this specific asset class, rebalancing historically reduced overall returns.
so the advice is basically let the winners run. If your 10% allocation grows to become 20% or even 30% of your net worth, you just let it ride.
Within reason, yes. You have to treat it like a venture capital bet. A VC expects most of their bets to fail, but the one that succeeds wins so big that it pays for everything else combined. You do not want to cap that upside.
Okay, so we have our strategy locked in. We do a 10% allocation, we automate the buying, and we don't rebalance. But what are we actually putting in that 10% bucket? Is it just Bitcoin? Or do we look at all these other thousands of tokens out there?
The book suggests splitting that 10% between the established blue chips, which would be Bitcoin and Ethereum, and maybe a few smaller emerging bets. But picking those smaller bets is really dangerous. That's where most people get totally burned.
Because they just buy whatever has a cute dog logo on it.
Exactly. They aren't investing, they're gambling. The book argues we need to fundamentally shift our mindset here. We need to stop looking at coin tickers and start treating these protocols like actual software companies.
Even though legally they aren't companies.
Legally, no. But structurally, yes, they absolutely are. They have users, they have revenue, which comes in the form of the network fees people pay to use them, and they have governance structures. So the book suggests using a technique from the legendary stock picker Peter Lynch. It's called scuttlebutt.
Scuttlebutt, I love that word. It sounds very nautical. But explain what it actually means in the finance world.
It basically just means digging for real-world information. Peter Lynch famously made an absolute fortune investing in Hanes, and he did it because his wife loved Legs pantyhose. She told him, "These are great, they're sold right in the grocery store, I buy them all the time, they're super convenient." He bought what he understood from real-world utility.
He didn't just stare at a moving average chart, he looked at the actual customer experience.
Precisely. So what is the crypto equivalent of pantyhose?
It's the UTDP rule.
Yes. Use the damn product.
I think this is where 99% of crypto investors completely fail. They buy tokens for projects they have never even touched.
It's startling how common that is. The author tells this great story about a crypto conference in Toronto. Everyone there is partying, drinking, talking about their moon missions and how rich they're going to be. But the smart investors, the whales, the ones who actually make money in this space over the long term, were going around the floor asking the developers one simple question. Who is actually building on this chain? Can I see it work right now?
So if you're thinking about investing in, say, a DeFi protocol, like a decentralized exchange, you should actually try to make a trade on it first before you buy the token.
Yes, absolutely. Connect your wallet to it. Try to swap a token. Is it fast? Did the transaction fail halfway through? Is the user interface a complete nightmare to navigate? If you, a person who is highly motivated and interested in the space, can't figure it out, then mass adoption is definitely not coming next week.
It's a great reality check. Because if the product is fundamentally broken, the token price is eventually going to reflect that, no matter how good their marketing team is.
Exactly. And once you've actually used the product, the book gives you a very specific scorecard to rate these projects.
Yeah.
It's a 5-point system designed to separate the real signal from all the noise.
Let's run through the key points of that scorecard because this is super practical. What's the first thing we're looking for?
Point 1 is the market problem. Is this thing solving a genuine, real-world issue? Like, Bitcoin solves the store of value problem. Filecoin solves decentralized storage. Dogecoin. Well, that's a meme. Doesn't solve a problem. Maybe entertainment, but it definitely doesn't have business utility.
Okay, that makes perfect sense. Point 2.
The moat. Just like you'd look for in traditional stocks, does the project have a competitive advantage? In crypto, this almost always means network effects. Why is Ethereum so valuable? Because that is where all the developers already are. It is incredibly hard to convince them to move to a brand new chain, so Ethereum has a massive moat.
All right, the network effect is the moat. Okay, point 3 is the team.
Credibility is everything here. Is the founder someone like Vitalik Buterin, a known, visible genius who speaks at conferences and publishes papers? Or is the founder an anonymous cartoon character avatar who just launched the project yesterday? Anonymous founders are a massive red flag for rug pulls, which is where the developers just steal all the liquidity and vanish into thin air.
Yeah, you definitely want to know who has your money. Point 4 is one that I think people find the most confusing: token mechanics.
This is critical, though. The book calls it the magic pie warning.
I love this analogy. Explain the magic pie to everyone.
Imagine you own 10% of a delicious pizza. You're feeling good. But suddenly, the chef comes out of the kitchen, slices that exact same pizza into 1,000 more tiny slivers, and just hands them out to a bunch of other people. Your 10% ownership just got diluted down to basically 0.01%.
Inflation.
Exactly. We all hate it when the government prints fiat money and inflates away our purchasing power, but crypto projects do the exact same thing to their investors all the time. You need to look at the circulating supply versus the total supply. If a project has only released 10% of its tokens to the public, and the developers are holding the other 90% in reserve to release later, you're going to get massively diluted.
Right. You want a hard cap. Something like Bitcoin, where the limit is rigidly set at 21 million coins. No more can ever be created, so you know your slice of the pie is safe.
Precisely. And that brings us to the final point on the scorecard, and arguably the most important one of all: user adoption.
Which brings us to a metric called DAU.
Daily active users. And this is actually where crypto is vastly superior and more transparent than the traditional stock market. With a company like Apple, you have to wait 3 months for a quarterly earnings report just to see how many iPhones they sold. In crypto, the blockchain is public. You can see exactly how many unique wallet addresses interacted with the network today.
It's real-time truth. You can't fake the blockchain.
Well, you can't fake it, but you do have to be careful how you interpret it. The book warns very strongly about airdrops.
Right. The free money giveaways.
Yeah. A project will say, hey, use our app this week and maybe we'll airdrop you some free tokens. Suddenly you look at the chart and see a massive spike of 100,000 new users.
But they aren't real loyal customers. They're just mercenaries looking for a payout.
Exactly. As soon as the free money is gone, they leave the network entirely. So when you look at that DAU metric, you want to see a steady, organic trend line moving up and to the right. Not just massive, erratic spikes driven by marketing gimmicks.
So if we pull this all together for you listening, intelligent crypto investing isn't about finding a magical lottery ticket. It's about careful portfolio construction, using that 10% insurance policy rule. It's about emotional discipline, automating your buys so you don't panic when things get scary. And it's about treating these protocols like real software businesses, checking the user numbers and actually using the product yourself.
That really is the middle way. It's making that crucial shift from just gambling to actually investing.
You know, as we wrap up here, I keep thinking about the very end of the book. There's this story about Brian Armstrong, the founder of Coinbase. And it really contextualizes the big why behind all of this.
It's a powerful story. Brian was living in Argentina for a while before he started Coinbase. And if you know anything at all about Argentina's economic history, you know it is just plagued by devastating hyperinflation.
We're talking about prices changing by the hour in the grocery store, life savings just wiped out.
He watched regular, hardworking people lose absolutely everything. And not because they made bad financial choices, but simply because the government mismanaged the national currency. Their money was literally melting in their pockets where they held it.
And that is exactly when he read the original Bitcoin white paper.
Yeah, and it clicked for him. He realized this wasn't just some cool tech experiment. It wasn't just a fun way to buy things anonymously on the internet, which was the prevailing narrative back then. It was a life raft. It was a mathematical way for regular people to opt out of a completely broken financial system.
I think that is the big provocative thought we want to leave you with today. We've talked a lot about returns and portfolio allocations and rebalancing rules, but fundamentally the real question you have to ask yourself is, are you investing in crypto just to get rich quick? Or are you investing because you suspect the current financial system, the dollars in your bank account, might actually be fragile?
And that is the true beauty of the 10% allocation strategy. You aren't sitting around hoping for the collapse of the US dollar. But if a crisis does happen, or even if the dollar just slowly, quietly loses its purchasing power over the next decade, you have insurance. You are mathematically prepared for both outcomes.
And that ultimately is why it pays to be an intelligent crypto investor. Not because you have a crystal ball and can predict the future, but because your portfolio is built to survive whatever the future brings.
I really couldn't have said it better myself.
Thanks for taking this deep dive with us. Go check your portfolio, look at your minivan and nitrous oxide allocation, and we will catch you on the next one.